According to ACCT's financial accounting textbook, petty cash fund is a small amount of cash on hand that is being put aside by a business to pay for small purchases. It is typically used to avoid dispensing checks, as minor expenses can be a hassle or small checks are not accepted. The amount of a petty cash fund is different across organizations. However, they all follow these 3 steps. Step 1, establishing the fund. Step 2, using the fund for making payments. Step 3, restoring or replenishing the fund. Establishing the fund is basically writing a check with an amount of the fund. The amount again is vary from company to company. Then cashing the checks to convert it into cash and entrust it to an employee we call a custodian. A journal entry will be recorded when the fund is established. Let's say on the 1st of January, Central Company decided to put $200 to a petty cash fund. This meant the company actually took out $200 from an actual cash account, leading to a reduction in asset and moved it to a petty cash account, which is a current asset account, in turn increase the assets. Therefore, this will not change the asset account and the money still remained in the company. Or journal entry will start with a date, in this case 1st of January. Since then we know petty cash increased the asset, we have to debit it. On the other hand, we credit cash to also reduce the asset by $200. Since the fund is established, the employees now can use it to pay for minor expenses like office supplies, fuel, postage. However, all expenses need to have physical receipts so they can be reported in the petty cash fund replenishment report at the end of the financial period. Remember, no journal entries need to be recorded when expenses are paid from petty cash. This is because we only record the entry when the fund is replenished. The final step is restoring the fund because, like a normal cash account, the cash in this fund does decrease. To fund the cash request for the fund, we have to count the remaining cash in the fund and deduct it from the actual petty cash fund. In Centra's company's petty cash fund replenishment report, the remaining cash was $40, meaning $160 was needed to replenish the fund. This amount theoretically should be matched up with the total of our expenses. However, our total expenses was $150, meaning there was a $10 discrepancy between them. This could be due to human errors or not all receipts were collected. This amount can be placed under cash over and short account in either debit or credit to balance the dual entry. In here, we would debit all our expenses and credit the cash on 31st of January. The $10 cash over and short would then be placed under debit so both entries can be balanced. Since the cash was taken out of our account through expenses, our asset account would then be decreased and so was our equity.